Hey, it's Vinny. So we've got three very interesting things to talk about today. I know it's in the title of the video, so we're going to discuss when the market will bottom first, how much money the richest people in the world have lost in 2022, and finally, stick around to the end as I have some really interesting statistics on the automotive market and how I think this will have a huge impact on the car market as we know it, affecting both traditional automakers, the transition to electric vehicles, and Tesla. So let's get right into it. So number one, stocks have obviously been crashing, as I'm sure we all know. In some cases, growth stocks are down 80, 90%. Now, this is all happening while we deal with the convergence of multiple unique issues, including price pressures, tightening financial conditions, inflation, supply chain constraints that have further been exacerbated by China's COVID lockdowns, and obviously we have Russia's war in Ukraine. In any normal year, any one of these five major issues would have been the top story. Well, now it feels like we're getting slammed by all five constantly. So dealing with all these problems at once has led to heightened volatility in the markets. So if your portfolio is down a lot this year, don't feel too bad. We're all hurting, I'm sure, and everything will work. Putting a worst case scenario, it could take 2 to 3 years, but if any of these five issues improve, things should get better sooner. You just need to think long term, and this will be nothing more than a hiccup when you look a few years out, as long as you have a long time horizon and you're a long-term investor. Now, when will the market bottom, you're probably wondering. Well, while history does not repeat itself, it does tend to mimic the past. On average, the market has taken 132 days to go from a high to the start of a bear market, and then 213 trading days to hit the low. Now, today is the 100th trading day since the S&P 500's peak, so about halfway to the historic average for the bottom. So while anything can happen, and as I said, I think if any of those five issues start to improve, we could bottom sooner, or if they get worse, it may take longer, but we may still have some time to go. For this reason, I've been taking buying very slowly, as I feel like there's still a lot of potential pain ahead. Now, if it makes you feel any better, the 50 richest people in the world have lost a combined $563 billion this year. Who needs a wealth tax? It's already here. Just crash the economy. So we're not the only ones hurting. I mean, the top 1% are not having a fun time in 2022. Go 99%, am I right? Now, on to a fascinating statistic that I think gives us an idea of what the future of the auto market may look like. Now, the average age of vehicles on the road hit a record high of 12.2 years in 2021, meaning people are keeping their cars longer and putting off buying new vehicles. Now, there are many reasons for this, but it is interesting to see that this was the fifth straight year the average vehicle age in the US increased. Now, if these trends continue, it really makes me wonder about how it all will affect the traditional auto market. And it seems all but inevitable that these trends will continue. As electric vehicles take over, which we know require less maintenance, we're looking at things like the million-mile battery. The longevity of cars should continue to increase. So who stands to benefit and who has the most to lose here? Traditional automakers, as always, are the losers, as this will translate to less sales for them and much less revenue from maintenance, which makes up a huge chunk of their revenue. It really feels as though traditional OEMs have nothing to gain if these trends continue, yet they have everything to lose. As we saw when we compared the operating margins from last quarter between Tesla and GM, both companies brought in roughly the same operating income of about $3 billion, but GM had to sell 5 times as many cars as Tesla to get there. Put another way, GM has to sell 5 times as many cars to make the same bottom line as Tesla. As GM probably sells less cars moving forward if these trends were to continue, their bottom line is just going to continue to fall. Now, you might be thinking, well, won't this also negatively impact Tesla? Well, at least over the next couple years, Tesla has an insane level of demand that they literally just cannot meet. I mean, we already know this. On top of that, Tesla boasts much higher profit margins on their vehicles and stands to benefit from pumping this money back into one of their several other business ventures. Whether it's autonomous driving, battery storage, solar panels, insurance, possibly even humanoid robots in a couple years and more, no one's talking about the insurance business, but they're saving people depending on their safety scores, somewhere in the ballpark, in some cases between 30 and 60% versus what people pay when they go through traditional insurance companies. I mean, that translates to an insane amount of money saved each year. I think this is something that's not fully realized, but will become more obvious in the years to come, and it is these seemingly small factors that will continue to set Tesla apart from the rest. So it seems hard to find any way that traditional automakers do not continue to suffer and decline in sales or bottom line revenue, while Tesla just increases theirs and has more money to pump into projects that will give them even more revenue. Now, during economic crises, people tend to hold onto vehicles longer. This was the case in the 08-09 financial crisis. So again, short term, all auto manufacturers' sales of new vehicles may suffer if things continue to get worse, but time and time again, it seems to me the traditional automakers have the most to lose while Tesla has everything to gain, as Tesla's demand is sky high and shows no sign of slowing down over the next year or two. They literally cannot pump out cars fast enough to meet the demand, while the demand for EVs is only increasing. Another nail in the coffin for ICE vehicles is that service visits are getting more expensive. The average service visit hit a record cost of $514 per visit in April, about 30% higher than the $394 per service transaction that was recorded back in January of 2018. Now, during these tough times, which it appears are only getting worse, consumers will look for any way to save monies, and EVs start to look even more attractive when you factor in, those savings on service costs, in addition to the already sky-high gas prices that just keep going up. When you factor all this in, Tesla seems like a clear winner both in the short and long term. And while all stock prices are going to suffer as long as we're in this downtrend, all of these things make me think that Tesla will emerge from the ashes, their phoenix that is going to rise stronger than ever while everyone else is really struggling. So sky-high demand while simultaneously saving consumers tons of money on car maintenance, which is close to non-existent with EVs compared with ICE vehicles, will save you a fortune on these insanely high gas prices and potentially save you hundreds more every month with Tesla insurance. The cost of new cars are increasing. Inflation is eating away at everyone's budget. All of these factors contribute to why I'm so confident in Tesla, and it's my number one holding. So let me know what you guys think in the comments below. Do you think legacy automotive stand a chance, or are the EV wars over before they even really began? If you enjoyed the video, don't forget to subscribe. This is Vinny from the Investment Club, and I'll see you next time.